as a manager of money, are you worried about the current state of the market?
I don't. Thanks for having me. I think if we look at the minutes from the Fed yesterday, we saw a very dovish stance from the Fed. They're talking about above trend growth for 2 to 3 years and inflation that is slightly above their target. And yet we saw interest rates not rising for 3 years. So to answer your question, the background is really conducive to risk taking. And all the indices that you just had on the board are simply reflecting how attractive conditions are for equities and generally risk-taking at the moment.
So risk-taking is positive right now. Jeff, do you agree here? It feels like the markets have run so quickly to the upside here. Is it still a situation where I can feel comfortable about investing in stocks and adding more money to positions?
In fact, we at Fifth Third feel there's some urgency to this. You have this mountain of cash, markets climb a wall of worry, you have a favorable Fed. All of that adds up to our thinking as a time when you need to own equities. There may indeed be, towards the end of the year or early into next year, there may be some consolidation and some more concerns over this loss of momentum, but you really can't fight this Fed. You can't fight the wave of money that's coming into the economy and into the investment markets.
Unwitty, with that in mind, I guess as we look towards the favorite parts of the market, I highlighted a couple of them in the segment just before you guys came on. This notion that we've seen emerging markets, places outside the U.S., do somewhat better than the U.S. markets right now. Can we expect to see that kind of performance continue, the world kind of lead because it's been playing catch up over the course of the last several years?
Yes, I 100% sort of agree with the assessment that Jeff had out there also, that we do expect non-US stocks, particularly emerging market stocks, to continue to outperform US stocks. Your graph showed that in the 1 year period, they're neck to neck. And indeed, for the last month or so, US has been catching up, partly on the back of a little bit of dollar strength. But as the year progresses, we expect dollar to be weakening again and international stocks to continue to outperform US stocks.
Are there parts, Unwitty, if you allow me to follow up here, are there parts of the emerging market that you think are better positioned to do well as opposed to just saying buying the basket of all of them in an ETF form?
We particularly favor emerging markets in the Latin America region at the moment. I think they have most of the catch-up to do if you look at their performance versus rest of the emerging market. And yes, they are coming off a rather pretty terrible COVID environment. So there is, it's generally been ignored for the last year or two. And that's one area where I think we're going to see some catch-up performance.
All right. Jeff, as we talk about this notion that there are kind of favored parts of the market, we've talked a lot about this idea that the big technology and media communications type stocks have been underperforming over the course of the last 6 months after outperforming over the last 10 years. Do we see a resurgence, a move back to big technology and comm services?
I think this is a pretty broad market where we will see most boats being lifted. However, we still continue to favor domestic SMID stocks as well as emerging market. Part of the rationale here is that this is a Federal Reserve that really means what they are saying. They want to reinflate prices. They want to keep rates very, very low, which means the short end of the curve is going to be anchored, but we do anticipate rising bond yields. That tends to stand in the way of some of these richly valued tech and telecom large cap names.
Okay, so when you say SMID, small and mid cap type stocks, are there certain sectors that are going to be the ones that are the ones you want to invest in domestically here?
So certainly the consumer is going to benefit here, but we also think some of the industrial names and even some of the material names can benefit in this kind of environment.
Okay. Unwitty, we're going to give you the last word here. If you can talk a little bit about the macro picture as you see it right now. You talked about this idea that we'll see constructive moves for risk assets. Are there things in your mind right now that you're paying the most attention to that could derail that upward thesis for risk assets going forward?
Yes, Tom, I think the most obvious one is if we see any sort of setback in COVID vaccination, either through some new strains or something, that is a perennial risk to the markets. But the second point is to do with inflation. Right now, markets very much think that that is the tail risk in the market. If it comes in stronger and more persistent than the Fed is anticipating at the moment, then that could be an issue.
Shepard Smith here. Thanks for watching CNBC on YouTube.